Good afternoon, everyone, and welcome to our latest webinar with Andy Crowder. I'm so thrilled to have you here today. Thanks for joining us. Thanks for taking the time out of your day to be with us. Today's event is called 85% Profits in 2017 with only 11 iron condor trades. This is the perfect trading strategy for summer. Andy has been crushing it with this strategy this year already, and we're psyched to be sharing this with you. So Andy, welcome to the webinar.
Yeah, thanks, Ian. It's good to be here, and it's good to see so many people interested in what we're going to talk about today. I'm really looking forward to this presentation.
Great. So real quick, I want to do a quick sound check. Can you hear me? Type into questions. That's where we're going to be chatting throughout the webinar. So if you can hear us, type in questions. Just give me a quick yes. You can hear me, that Andy and I are coming through loud and clear. So I'm getting some yeses there. Perfect. And where are you joining us from? Where in the world are you? It's always fun to see where folks are tuning in from. We're here in northern Vermont. We're just outside of the college town of Burlington, and psyched to be here today. So I see people from all over San Antonio. I have Mark in Las Vegas. I have Bob in the northwest suburbs of Chicago. So yeah, people from all over Germany. Yeah, hey Peter from Germany, welcome. Great. So excellent. We have a great presentation. We're going to get right into it. I want to let you know today that you're in the right place if you want to earn extra income every month. You're in the right place if you've tried options trading but have lost money. You're also in the right place if you want to learn the safest ways to win 80 to 90% of your trades, because let me tell you, if you're winning 80% of your trades, it's almost impossible to lose money. We're going to show you how. And if you want to learn how to trade like a professional, Andy's going to teach you how to do that today. So real quick, we're going to read a quick U.S. government required disclaimer, and then I'm going to turn it over to Andy and let him get right into this. So this U.S. government required disclaimer says Forex futures, stock, and options trading is not appropriate for everyone. There's a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure the avoidance of losses. No representation or implication is being made that using the strategies or tactics or information on this website or accompanying material will generate profits or ensure the avoidance of losses. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as a lack of liquidity. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown today. Great. Now that we have that out of the way, just want to let you know we are an investment research and education firm. We're focused on teaching trading and teaching new strategies and sharing ideas. We are not a registered broker-dealer or financial advisor. My name is Ian Wyatt. I started investing when I was just a few years old with a few shares of Exxon that my grandparents were generous enough to give to me. I've always been a long-term investor focused on buying great companies and owning them for the long term. And I turned my passion for investing in the financial markets, turned it into an investment research firm that today is known as Wyatt Investment Research. We've been named one of the fastest growing privately held companies by Inc. magazine on their Inc. 500 list, as well as by the accounting firm Deloitte in the Fast 500. And I've always been focused on long-term investments and finding great companies. A few years ago, I asked Andy to join us here at Wyatt Investment Research because I realized that there was an opportunity and that my members, my clients, wanted to learn more about active trading strategies for using options in safe ways to earn income, reduce risk, and beat the market. So Andy joined me. He started trading at Oppenheimer and Company on Wall Street, where he learned how the professionals consistently make money. Today, he teaches over 10,000 investors every year how to trade just like a professional with our group here at Wyatt Research. So it's great to have Andy here. And I know he's worked really hard on today's presentation, and I know you're going to love it. So real quick, I don't know why you invest. I know for me, it's all about my family and my family's future. So here's just a few photos of me, with my wife, and we have 4 little kids. And I got to tell you, we're psyched for summer because summer in Vermont, there's nothing quite like it, and we're going to be spending time outside hiking and in the woods and out on the lake. So, that's why I invest. I invest for my kids' college education, which we all know is ridiculously expensive, and saving for my own retirement as well. So I don't know why you invest, but for me, those are my goals, and these types of strategies that Andy's going to share with you today are perfect if you're looking to earn more income, whether it's to pay the bills today, help pay for your kids or grandkids' college education, whether you're saving for retirement, or whether or not you're already retired and you just want extra income and you want to do well, stretching your savings a little bit further. So these are going to be perfect for you. So Andy, I'm going to turn it over to you now.
Yeah, thanks, Ian. Basically, here's a few pictures of myself and my family, and the reason why I invest is very similar to most of you, including Ian, for basically family, college. One great thing is, as Ian mentioned, school's out for summer, so we love to when that happens up here in Vermont, because as Ian has stated, most people live here for the outdoor recreation, and that's what we really enjoy up here. So, that being said, let me tell you about just a quick story, a little bit about my background. I've been trading options for roughly 2 decades. I was very interested because I have a science background. Excuse me. I was interested in options early on, but there just wasn't, two decades ago, there just wasn't a lot of information out there. The majority of the information that was out there was in regards to buying options. So, like most people who are new to options, I ended up buying naked options, buying calls and puts. The leverage was enticing, as my account was rather small coming out of college, but I came out of the gate with some incredibly lucky trades, so my confidence was very high at the beginning. At that time, I had made roughly $7,000 from a small account, which for me at that time coming out of college, I felt like I was printing money. Well, I can tell you, like most people who start out buying options and having some success and gaining that confidence, what was really overconfidence. It didn't take me very long for that streak to end. Actually, it only took me about a couple weeks. And like most newbie traders, I tried to recoup my losses by taking a larger position sizes. Basically, I was falling into the same trap that everyone that's new to options fall into. I was playing that fool's game. I didn't understand the odds or the probabilities behind the trades that I was making. And that was until I met my mentor, a gentleman who was one of the first floor traders at the CBOE. Just one of those things where I was very fortunate to meet this guy. He kind of took me under his wing because he saw that I was very interested in options and trading options for a living, and so he kind of showed me the way, taught me how to use option selling strategies, taught me how to use the statistics, the probabilities. And I always get these questions from skeptical clients or subscribers. And they'll ask, so if you're just such a successful trader, why don't you trade for a living? Why are you teaching me? And mostly it's because I'm paying it forward. I love trading, but I also really enjoy teaching people how to trade options. This is my passion. This is what I love to do. I'm not going to do anything that is proprietary today when it comes to the use of strategies. That's all a hoax. There's no foolproof systems out there that I'm going to teach you. Trading options is simply about discipline and consistency. We all use the same option selling strategies. It's the minutia within that trading that determines the success, and these lesser known concepts are what I like to teach. And yes, I love teaching these strategies, these option selling strategies, but again, it's the small stuff like proper position size, which strikes, which probabilities to use, etc., that determines the long-term success of an options trader.
Great. So real quick, this is what you're going to learn today. You're going to learn Andy's #1 strategy and how it's delivering year-to-date gains of 85%. You're going to learn how he's doing this with only 11 trades, and that's really great if you're someone who says, look, I don't want to be day trading. I don't want to be making new trades every single day. With Andy's strategy, you can be making about 2 trades a month. This has become a #1 strategy for professional traders, and we think it's a perfect time to be using this strategy in this market. We're going to show you how you could win at least 80 to 90% of your trades and how to earn 8 to 25% gains per month. Additionally, we're going to show you how you could collect $1,327 before July 1st. You're going to discover how to do this with 3 live trade examples and get all the details on how to access Andy's Iron Condors portfolio. Plus, we're going to be doing an extended Q&A session answering every single question that you have. So please do stick around. I do want to let you know that Andy is actually right now winning 91% of these trades. He's going to show you exactly how to do this. Stay until the end of today's webinar because we are recording it and will be sent out to people who stay with us for the full hour. As well, we have 3 live trades that we're going to be sharing with you, and we want to show you how to use these real-world examples. This is a live webinar. Remember, this is taking place on Wednesday, June 21st. It's just after 12 p.m. Eastern Time. These are going to be live trades in the market right now. This isn't some pre-recorded webinar that you're watching. This is a live event. So with that, Andy, I'm going to turn it over to you. Let's get right into iron condors and how exactly this works. And
Yeah.
real quick, can we do one poll before we do that?
Oh, yeah, definitely.
Great. So real quick for our audience, what's the #1 reason you're joining us today? Is it because you want to learn a new trading strategy, because you want to see 3 live trades, because you want to participate in our question and answer session, or is it simply because you're bored at work or have nothing else to do and you just decided to tune into this? So give me a quick vote. I only have about 15% of people voted. I really like to see at least half of my audience voting in these polls. So go ahead, give me a quick vote in the quick poll, and we'll turn it right over to Andy.
Yeah, thanks again, Ian. And I'm going to be going over a lot of information today. So as Ian said, we're going to have a Q&A at the very end. So that's where we're going to answer any and all of your questions regarding the strategies or options in general. So let's get started. So I'm often asked, why doesn't every investor do this? This is a question, again, that I'm often asked from readers, subscribers, really anyone that's interested in options. First is the poor experience investors have had with options in the past. Most of those burned by options have lost money buying options. I spoke about this before. Because this is a low probability sucker's bet. You have to think of it like this. We always want to be the house, that being the casino, or the insurance company selling those premiums. We want superior odds. We do not want to be the investor or the guy taking sucker bets, guessing numbers on a roulette wheel. Second is the genuine lack of education when it comes to options. Most investors don't have a sound understanding of how option strategies work. They don't understand the statistics and the importance of the math behind each and every strategy. Third is that no one is going to do this for you. Your advisor will not manage option strategies for you because there just isn't enough money in this formula relative to the risk involved. He's not going to watch option strategies like an iron condor or any other option selling strategy because he has hundreds of clients for which he has to make financial plans. Excuse me. Mutual funds don't do this because it's not in their charter. Hedge funds are too big. They just can't step up and start building $1 billion position in the options market. So today, and that's why this is perfect for retail or individual investors, like all of us here today. So today, I'm going to teach you my step-by-step approach to iron condors. I'm going to start out with a little background regarding the way I approach the market, followed by a few iron condor basics. I'm then going to layer my approach into the discussion with a few trade examples, and then we're going to move over to the platform, as Ian stated, and we're going to go over a few applications of how I trade iron condors in real time. And of course, as always, we're going to have an extended Q&A session at the very end. So, in regards to options trading is not about analyzing a company. In fact, most analysts have no idea what it takes to be a successful trader. They're focused on earnings, revenue growth, and a slew of other fundamentals. While necessary in other circles of finance, this type of information is practically useless when it comes to trading options. None of it matters. It couldn't be further from what you should be focused on when it comes to options trading. This is something that most people don't quite understand. But we're going to go over this as we go through the presentation. We're going to talk about the numbers and the importance of following those numbers, those probabilities, the statistics, and so on. So again, it's about the math. You're going to see a theme here. I don't use anything that I learned in finance when trading options. Again, fundamentals don't matter. What you need to focus on is the math. Now, we're trading high probability strategies that at order entry, so as soon as we place that order, we know exactly what our probability of success will be on the trade. And the way that we trade, that ranges from 75 to 85%. Now, knowing this, a win ratio of 80% or slightly higher is expected over time, and that's because of the probabilities. And again, that's because we're making trades with a probability of success of around 80% on average. So we should always have that expected return in mind. It's not, when we say, oh, we've made 90%, in iron condors over the course of the year, it's not because we've been doing anything extra special. It's because we've allowed the probabilities to work themselves out, and we've taken advantage by doing all the small things, and I'll get to that in a moment. But again, you must allow the probabilities to work by creating a sample size that is sufficient. You can't make 10 trades and call any strategy a failure or a success if the sample size isn't large enough. Why is that the case? It's called variance. Now, success in high probability trading is building your number of high probability occurrences or trades. So those expected results come to fruition. Again, it's all about the math. Now, this is a chart from the journalism department of University of North Carolina, of all places, that discusses being badly misled by a sample size of only 10. So basically this was meant for people doing polls, and they have very small sample size. So as you can see, flipping a coin 10 times and doing this 10 coin trial 1,024 times leads to some revealing statistics. What it says is that the range is going to be anywhere from 3 to 7 on the number of heads that you have. But as that number of occurrences increase, and in our case the number of trades increase, the variance tightens. So that 3 to 7 heads eventually turns into where it should, which is the 5, where that expected result is. The same goes as we increase our sample size of our trades. The probabilities for our trades begin to fall in line with their expected results. In our case, our high probability trades with a 75 to 85% should fall in line around that range. But this isn't enough. You must couple the strategy with a disciplined risk management plan. Excuse me. Now, I'm a big proponent of making more small trades using roughly 1 to 5% of per trade. It's kind of a sliding scale, diversifying amongst a variety of mostly index ETFs and a few stocks, but also diversifying amongst strategies as well. Now, knowing the probabilities will work inherently, well, the probabilities are going to work, and that they're going to inherently work themselves out, you must have a disciplined risk management plan, and this starts with and practically ends with position size. Now, I say this because position size is the only true way to limit your risk. Therefore, in my opinion, proper and consistent position size is the most important step in the process, but I'm going to get to that a little later with a few examples. Now, you'll notice that I'm talking about this before I even get to the strategy, because these are important concepts that you must know and that you must be prepared for when taking on any type of option strategy. Most people don't really discuss this enough, but it's very, very important to know these types of things, to have a risk management plan in place. And this is what we talk about within these strategies when we're going through it with subscribers.
Can I just jump in here with a quick question, Andy?
Yeah.
Great. So we're going to do another poll right now. How many options contracts are you typically trading? I just want to get a sense of the trading activities of the folks on today's webinar. So how many options contracts do you typically trade in your account when you're trading? So just give me a quick vote here. It looks like I have about 20% of people voting, so I want everybody here. Go right now. It says quick poll. It should have come up on your screen. Give me a quick vote to let me know. And Andy, looks like we have about 15–20% of people aren't trading at all right now, and most people are trading anywhere between 1 and 6 contracts. It's pretty typical for our audience today. So that's pretty interesting. Related to that, I'm just going to do another question right now for our audience too. My question is, how much capital do you have in your trading account? If you feel comfortable answering this, that'd be really great. I'm just curious, get a sense of how many trades you're making, how much capital you're using when you're trading. So give me a quick vote right now just to let me know how much capital do you have in your trading account where you're doing these active trades. I'm not talking about a 401k retirement plan or something like that, but just in a trading account where you're actually doing these trades. I'm curious to see sort of how much you guys are actually trading. So Andy, I'll turn it back to you right now as well.
Yeah, thanks. And it'll be interesting to see once you find out the results. Let us know, because it's going to be interesting to see what those results are, because we're going to be talking about account size and position size as well. So this will be a good stat to find out as we move through the presentation. So
great.
Really quick, so let's go through this because I've kind of started out a little slower, so I'm going to be picking it up a little bit. So as I've discussed numerous times in the past, it's rare for the S&P 500 to move 8, 7, 6, even 4% over the course of 1 or 2 months. So If we know the aforementioned fact, why do we sit on our laurels during these times of complacency? Why do we not take advantage of the tools or our tools that will help us achieve a stream of conservative, consistent returns while we wait to collect dividends or lock in capital gains on our long-only portfolios? Why aren't we hedged using option strategies? Why do we only expose ourselves to the long side? Which means, why do we only benefit from a market that's going higher? Especially in markets similar to today's market, we're starting to see a little bit of fear creep in. Volatility is still low by historical standards as seen through the VIX. But again, we're using these strategies to create essentially a dividend or a stream of consistent income. We want a smooth equity curve when we're doing this. So when we look at the performance of the S&P over the short term, say every 30 to 60 days, the major market benchmark typically just chops around sideways, not making any significant directional moves. But even when the market is volatile, iron condors thrive due to the increase in prices, which I will show you shortly when we move over to the platform. So knowing all of this, we want to wrap a high probability strategy that basically says the market over 30 to 45 days, sometimes 60 days, 60-day period, is going to stay in its expected range. So now let's get to the basics of the Condor. Now, an iron Condor is a defined risk, non-directional option strategy that by definition is designed to have a large probability of earning a small limited profit on a highly liquid underlying security, much like the S&P 500, the Dow, the Russell 2000, the Qs, which is the NASDAQ 100. Now, an iron condor benefits from the passage of time and a decline in the implied volatility, but when used properly, it can produce some very nice monthly returns, and we've seen that since we introduced our iron condor portfolio back at the beginning of 2017. Now, as the payoff diagram shows, this strategy profits as long as the stock or index you're trading stays within the two upper and lower spread positions. Now, that max profit zone is going to be between B and C. Now, an iron condor is a great trade for smaller accounts and beginners because you define your max loss when choosing strike prices at order entry. But because it's a defined risk trade, it also requires less buying power, which frees up capital to place other trades. Now, the first setup when we're creating an iron condor, as you can see, we want to be between that B and C. That's where our max profit's going to lie. Now, we're doing this simultaneously because when you're doing an iron condor, it's essentially creating two vertical spreads. But I'm going to take these separately. I'm going to start out with the call spread first, and I'm going to move on to the put spread. But in most cases, as I'm going to show you, we do this simultaneously. So the trade setup is going to be we're going to sell an out-of-the-money call vertical spread with at least a 75% probability of success, preferably higher. We often have used iron condors above 80%. Now this consists of simultaneously selling a call at strike price C and buying a call at strike price D. Again, this is known as a bear call or vertical call spread. Now, what you're seeing is the options chain for this particular underlying. The stock is trading at roughly 127. So that being said, let's see if I can do this really quickly. The laser pointer, it works. So we're going to go to the probabilities. And as you can see, if a stock's trading at 127, we're going to go above that for the first half of the iron condor, or that first leg. And we're going to go up to the 75% probability of success. But we actually want to move, if we can, all the way up to the 82.35, or the 138 strike. Now remember, that gives us an 11-point margin of error, because again, the stock's trading for roughly 127. And we have and it's basically what the market is telling us is that there's an 82% chance that this underlying index is going to close below the 138 strike at expiration. Now we would sell the 138, and then we're going to define our risk by buying either 2, 3, or 5 strikes out. By buying the strike 2, 3, or 5 strikes out, and by doing so, we're able to again define our risk. Obviously, if we only sell 2 strikes out, our credit's going to be less. But our risk will be our premium will be less, but our risk will also be minimal. And as we go further out with our spreads, let's say we go with a 3-strike wide spread or a 5-strike wide, the risk or the maintenance requirement will be more, but our credit will also be more. So that would be the first half of the Iron Condor. Now the second part is going to be, and again, just as a reminder, we do this simultaneously when placing these trades, and I'm going to show you that once we get to the platform, but I want to take this piece by piece. So the second part will be we're going to sell an out-of-the-money put vertical spread with at least a 75% probability of success, preferably higher. This consists of simultaneously selling a put at strike price B and buying a put at strike price A. Again, this is known as a bull put or vertical put spread. Again, we want that stock to fall between B and C at expiration. Although we typically take those trades off early, and I'll get to that in a moment as well. So what you're seeing is the options chain for this same underlying security. Again, it's trading for 127. It's going to be the same thing. We're going to look for that probability of success. We're going to go to the 82%. That's the 113 strike, and we're going to sell the 113 strike, and then we can either buy the 111, the 110, or well, basically the 111 or the 110. So we can either go 2 or 3 strikes wide. Now again, we want to make that consistent on both sides. So if we do 3 strikes on the call side, we want to do 3 strikes on the put side. I typically do 2 strikes, but I will be integrating more 3 to 5 strike wide Iron Condors, just because for one, we're able to bring in more premium, and it's a little cheaper for commissions as well. So now let's move on to the max profit. So basically the maximum profit potential for an Iron Condor is going to be the net credit received by selling the out-of-the-money call and put call vertical spread. So let's say by selling this Iron Condor, what I told you before, what I showed you before, that call side and the put side. So we sell both of those, and combined we're able to bring in, let's say, 75 cents. So that's going to be our max profit. So it'll be 75 cents, and let's say we go 3 strikes wide, so it's going to be 75 minus that 3 strikes wide, which will give us 225. And if we take 75 divided by 225, that's going to give us a 33.3% return if the underlying security at expiration falls between our 2 short strikes, that being B and C. Now again, you can see this is both sides, the call and the put side, and you can see basically what we were talking about with both sides. We want to go with that probability OTM, or probability out of the money. We'd go to that 138 strike, and we would most likely sell something 2 to 3 strikes out. It doesn't look like 3 strikes out is possible. We'd have to go out to the 140. So we would go 2 strikes out on the put side as well in this case, and that would be going to the 113 strike and selling that 113 strike and then buying that 111 strike. And again, the reason why we buy the strikes is to define our risk, and that allows us to create a risk management plan. That allows us to create a proper position size as well on each and every trade that we place. And because we have to have this plan in place because we need to allow the probabilities to work themselves out. That's the most important piece of all of these option strategies that I talk about, including Iron Condors. You must have a risk management plan in place because that is what allows the probabilities to work themselves out over time. That's what allows those occurrences to increase and therefore make a profit again over time. We have to allow that sample size to increase and allow those probabilities again to work themselves out.
Hey Andy, speaking of managing risk, can I just do a quick poll real quick?
Yeah, definitely.
Perfect. So I have a question for our audience. What is your biggest trading challenge? So tell us, what's your biggest trading challenge? Is it that you're just getting started? Is it managing risk, which Andy was just talking about? Is it inconsistent trading results? Is it that you're actually losing money in the market, which would be pretty horrible? Or is it that you're just not earning enough income? Give us a quick vote and let us know, what's your biggest trading challenge? About 25% of people have voted. So for the rest of you on the webinar, I need you to go to that quick poll right now. Give me a quick vote, select the answer, and then just click the submit button. That gives me the response right now. So thanks so much for doing that. Andy, I'm going to turn it back to you. You there, Andy? I'm not getting...
I am here now. I have to unmute myself if people want to hear me.
Perfect. Great. Sounds
So
good.
anyway,
Go ahead.
the let's get back to the presentation. So this is a slide of the break-even point. So basically, as I said, let's say we brought in 75 cents. That's going to basically mean that our break-even is going to be that C plus our credit received, and that being our total credit. So as you can see here, that's going to be right where this crosses our line. That's our break-even on both sides. So that, again, that's just taking that short strike. In this case, the C is our call strike, and we're going to add our premium, our total premium for the Iron Condor. That's going to be our break-even. On the put side, we're going to have our short, that short put strike, and then we're going to subtract our credit, and that's going to be our break-even on the downside. So again, by creating a little larger credit, we're actually increasing our probabilities even further. So that 82% on both sides is probably more like 84 to 85% probability of success. So now that we hopefully have a firm grasp on the mechanics of a basic Iron Condor, let's take a look at how I approach Iron Condors myself and why they're one of my favorite options trading strategies. Again, the basic premise of the strategy is easier to understand as we go through this, but the key part and the real advantage of this trade is this. It's that you choose the price range of the trade and the strikes. Increasing the range of the short strikes will decrease your potential profits, but it will increase the probability of success. So how do I choose the appropriate strike prices to use? I've learned over the years that probabilities are your best friend when trading options. Knowing what the likelihood is that the market will move in such in a specific range or an expected range, the probabilities really helps determine if the trade is worth risking any capital on any one particular trade. And it's these probabilities that keep us profitable as option sellers over the long haul. Now, the probability of success, as I said before, once you've decided on a highly liquid ETF or stock, the search then begins for a high probability trade. I like to choose an expiration cycle with 25 to 65 days. My preference is to go out about 56 days, and but then I look for trades with at least an 80+ probability of expiring out of the money. Now, basically, here are the basically what you're seeing is the options chain, and these are the probabilities. And this is for SPY, or the S&P 500. Now, I wanted to choose an Iron Condor trade with a probability of success around 82%, which is why I want to look at the 250 calls on the, and that's what you're seeing now on the call side, and the 230 puts, which you will see shortly. Now, again, it's all about the probabilities when we're selling options. The higher probability of the trade, the less premium you're able to bring in. But again, I tend to side with the odds, which is why I typically choose a higher probability of success with each and every trade I make. I'm not trying to be greedy. Again, we need to act like the casino. We need to act like an insurance company. Take those small premiums and move forward. That's why we've been able to make on average 9% per trade since we introduced the portfolio. Now, this is, since we went with that call side, let's go back really quickly. We are selling the 250 call, and then we're going to buy the 253 call. So we're selling that 250 strike. We're going to buy the 253 strike. Now, as you can see, this is what this looks like on the call side. So this is where SPY is trading. You can see it's trading for 243. We have a $7 margin of error. Now, so basically, the S&P can move, it can float anywhere around as long as it stays below our call side of our Iron Condor will be perfectly fine. Now, this red line is where we purchased that 253, and that's what defines our risk. Now, this is the put side. Again, how do I choose the right strikes? I use the probabilities. So now I'm going down to the put side, or over to the put side. I'm going to choose that 230 strike. I'm going to sell the 230 strike, and I'm going to buy the 227 strike. Now, selling this 230 strike, again, this is in SPY, the S&P 500. This is going to give me an almost an 84% probability of success. Now, so basically now with a range of 20 points, and our short strikes are between 250 and 230, and SPY trading for basically around 243, SPY can move as high as 250 or as low as 230, and we're going to be profitable in this particular trade. Now, of course, the goal is to take the trade off early, preferably within 30 days left until expiration. That's why I prefer to go out roughly 56 days, but I will go out as low as 30 days, but I'm always trying to take off my spread early to lock in those profits. So let's say in this case, this trade will make roughly 69 to 70 cents, or roughly 30% if it closes within the established range by August expiration. That's if it closes between 250 and 230. Now, by taking off the trade for roughly, let's say, 35 to 40 cents, we're still going to make 13 to 15.5% on the trade. Now, research shows time and time again, and there's a lot of it when it revolved around this, is research shows that it's overwhelming. It's to take profits. You want to take profits when 50 to 75% of the premium has eroded. So that 70 cents that we sold, once it erodes down to 35 or 30 cents, we want to go ahead and lock in the profits, decrease our exposure to future price, movements, and then move on to another trade, establish a new range. We want to continually ladder these trades, much like people when they retire, they ladder bonds because they want that consistent stream of income. Now, here's the overall trade and what it looks like. So again, we want to stay between those blue lines, that 250 and 230 strike. Those red lines that you see, those are where we purchased those options. That defines our risk. Now again, as long as SPY stays within that 20-point range, which is an enormous range, we're going to make a profit. So basically, here's the actual trade. So the following are going to be options with 59 days left until expiration. We're going to simultaneously, again, because we're doing, even though I've shown you one half, and then I've basically divided this out in the call side and the put side, you're doing this simultaneously, as I've mentioned. You want to sell to open that SPY August 250 call. We're going to buy to open that 253 call. We also want to sell the 230 put. We're buying to open that 227 put. We can do this based on the prices given for roughly 69 to 70 cents. Now, the goal of selling this SPY Iron Condor, as any Iron Condor, is to have the underlying ETF, in this case SPY, stay between our short strikes, which are 250 and 230. The parameters of the trade, our probability of success is 82.5% and almost 84% on the put side. Max return on the trade is 69 cents, or almost 30% based on the required margin over the next 59 days. But remember, we're not always allowing this condor to expire worthless. In most cases, we're actually taking it off early, locking those profits, and again, moving forward. Our break-even levels, as I've shown you, is 250.69 and 229.31. That's simply taking those short strikes, and on the call side, adding our total premium for that Iron Condor, for selling that Iron Condor, and then subtracting that premium on the put side, and that being the total premium that we're able to bring in by selling that Iron Condor, and that's going to give you your break-even level. So now let's move on to risk management. This is where most people tune out. Don't. Because if you don't have a strict risk management plan in place, I promise you, you're going to fail. You can't tell yourself, oh, I have a hunch on this particular trade. I'm going to ramp my position size up to 15, 20, 25%. If that's something that you're accustomed to, that's one thing. If you have a constant position size of, let's say, 15%. Although that is a little large, you can't just willy-nilly choose random position sizes. Now, you can have a sliding scale within a small range, like what I'm about to show you, 1 to 5%, for example. But you don't want to say, okay, I'm going to make 5%, 5%, 5%, 30%. It doesn't work that way. You need to look at each trade the same. It's the same as if you were to go to a casino. It's the same way that insurance companies look at their risks. You need to be diligent and have a strict risk management plan, because it's all about consistency. It's all about allowing those probabilities to work themselves out over the long term. Now, there's no doubt that the guys over at, let's say, Tasty Trade do some nice research. A recent study that they used, they were comparing two $10,000 accounts, which, as industry has stated, is the average trading account 40,000 is the average size brokerage account for any of those who are curious. Anyway, a recent study using two $10,000 accounts with different trade allocations showed the following. Now, the first trader, Trader A, only used 5% a month for each Iron Condor trade, investing $500 of his $10,000. The second trader, Trader B, used 50% a month for each trader, $5,000 of his $10,000. They both had a win ratio of 75%. Now, Trader B, even with a 75% win ratio, lost over 50% of his overall capital. Trader A, by only dedicating $500 or 5% per trade, was up 10%. And remember, that's just using 5% of the account on one trade per month. Proper position size leads to a smooth equity curve. And that's what we want in an income strategy, like an Iron Condor strategy, a smooth equity curve. We don't want huge swings in our account, and we want consistency in our profits. Basically, as I've said time and time again, we want to allow the probabilities to work in our favor. Now,
I want to do a quick poll, Andy. I'm really curious about this.
yeah,
Have you ever traded Iron Condors? Go ahead and give me a quick response to this quick poll. Have you ever traded Iron Condors? Just give me a quick yes, no, or I don't know. I'm just curious to know if people are actually trading Iron Condors right now. I know it's been growing in popularity. We've been doing a lot of work, recently telling people about this strategy. So I'm really curious. So Andy, I'll turn it back to you.
yeah, thanks, Ian. So there's one thing that we can all agree on as responsible investors. We don't want to lose money. Now, the killer to trading accounts are drawdowns. Higher levels of allocation per trade can lead to unmitigated disaster. Don't make this mistake. I often see this with those new to trading, and it's unfortunate because improper allocation can ruin one's account. And then that leads to people getting frustrated, discouraged, they don't get back into options, and they don't allow themselves to truly learn the benefits of using options. And it's because they fail to use proper allocation on a per trade basis. Remember, I'm going to say this I'm going to say this again, it's all about a smooth equity curve. But it never fails. Inexperienced traders always state that they either don't want to miss out on a large winner or don't want to miss out on that upcoming winning streak. You can't allow these thoughts to enter your mind. Each trade needs to be approached the same. Hunches, they're useless. So the number one area that beginner traders get it wrong is consistency. The number one area, they lack consistency. Now, if you really want to use Iron Condors, again, you must be consistent. It's imperative. There's no ho-hum about it. Without consistency, you are going to fail. So please don't waste your time on using an Iron Condor strategy if you lack the discipline to be consistent. It's about being consistent in the approach that you use with each and every trade that's going to make the difference. If you know you're going to win roughly 80% of your trades by using a high probability strategy like Iron Condors, you must again be consistent, not only in your order entry, but again, as I've stressed before, with your risk management techniques. Now, the most important decision you'll make as a successful options trader is how much to allocate per trade. From a risk management standpoint, maintaining a consistent position size among our trades is of the utmost importance. We want to limit the havoc that one trade could potentially have on our portfolio. Now, as you're seeing here, this is a stat that most people don't realize, is that the chance of going bankrupt with a 5% allocation is 1 in 3.49 billion. That is staggering. But for some reason, people don't allow these statistics to work in their favor. They want to ramp up the position size because they have a hunch. I mean, there's a variety of reasons. So we're going to talk about an allocation of 5% per trade. So how does that look? We have a $10,000 account. Again, that's the average account size for, as you know, industry states. Now, one position is equally weighted at $500. So with each trade, a 10% drop is going to cause a 0.5% drop in your overall portfolio. 20% will cause a drop in the overall portfolio, 1%, and you can see a 50% drop will cause a 2.5% drop in your overall portfolio. Our stop loss, for example, with 5% allocated per trade, might be $250 or 50%. Now, So basically what that means is if we were to bring in 75% for an iron condor, we would get out of that iron condor once it reaches $1.50. Now, for example, if we had 4 iron condor trades open simultaneously, we'd have $2,000 in play, but we'd only have $1,000 or 10% of our overall portfolio at risk. And again, that's taking a max that's taking a max loss on those trades. That's assuming a max loss. And to receive a max loss, that requires the underlying stock not just to move through our short strike, either our short call or short put. It must move or breach those long strikes where we've bought, where we've defined our risk. So if we go back to that SPY example where we had that 250, 230 range, it'd have to get pushed past 253 or push below 227, and the probabilities of that are even less than pushing through those short strikes. And so that's the only way that you would receive a max loss in the trade. So that's a rarity. Now, just as there are different ways to play chess, there are different strategic methods for position size. Each person is different. Some may wish not to take 5%, some may wish to take 10% per trade or even more. You have to do what fits your risk tolerance. There's also factors to consider like total capital dedicated to the strategy. If you have a smaller account, in most cases, you're going to need to take on a larger position size. Now, why do we invest this way? Because we know we can create a significant statistical edge. We can make money while simultaneously lowering the risk of our overall portfolio. We can make money in up, down, or sideways markets. And remember, we always want to be the house. So one other thing that I want to touch on is commissions before we get to the examples. Now, commissions are a component of trading that can't be avoided, as we all know, and iron condors can be commission heavy if not used correctly. Now, the fees on trading options may look similar to stocks, but they will eat you alive due to the opening and closing nature of options trading, as well as the management of profit if used incorrectly. And this is especially the case for smaller accounts. Now, take an example of an iron condor which involves 4 different options. And let's say that I'm targeting a 50% profit on an iron condor, which means if I bring in a premium of, let's say, $100, I'll be exiting that trade once the value of the iron condor has declined to $50. Now, to open a trade at one of the cheaper brokerages, you pay a base fee of $4.95, then an additional 50 cents per leg, which comes out to $2 on a 4-legged iron condor. This is the case for Options House, Scottrade, Fidelity, TD, Schwab, so on and so forth. So your total opening commission is going to be around $7. Then to close the trade, you're going to pay that same amount of $7. Now that's just based on that that first spread that you make. Now if you use that first contract, if you ramp this up to 2 contracts or 10 contracts or 30 contracts, you're not going to have to pay that base fee of $4.95. You're going to just pay that 50 cents. Now if we were to just go with the one, your total commissions on a round trip trade, it's going to be roughly $14. So if you're only bringing in $50, that means you're paying roughly 28% of your profit in fees. That's just based on one contract. Now that decreases significantly once you start to use 2 contracts, 3 contracts, so on and so forth. But let's rework the example I gave about this iron condor that we sold for $100 credit. There are other brokerages that are new to the game that are stepping in, that my guess other brokers will join the move to lower commissions to remain competitive, that currently charge $4 in fees to open and none to close. This has kind of been the progression. The progression with commissions, it used to be outlandish how expensive it was. Then it moved to discount brokers and everything was significantly cheaper. Then it moved to people were starting to understand the importance of selling options. So then they said to themselves, okay, anything below 5 cents, we're going to, if you get out of a position that's less than 5 cents, you can do that for free. Then it moved up to 10 cents. Now we have brokers that are saying any closing trade you're not going to pay on. So you're not paying on that entering an iron condor or any type of trade, and then paying also on exiting the trade. You're only paying on one side. So managing that $50 profit before, which cost us $14, now only costs us $4. That's a swing of $10, which may sound small, but when you're opening and closing trades like these every few weeks, and it can add up quickly. But here's the deal. You need to negotiate your commissions fees. They're going to start you out with the flat rates. I can promise you, if you call, because brokers want to keep your business, and any threat of jumping ship will lead them to offer you some very attractive commission structures, especially if you tell them you are selling options. Again, this mostly affects those that are trading one contract and only bringing in a minimal amount of premium. But here's another way to combat commission fees when you have a small account is to trade with wider spreads. And while this may lead to a larger maintenance requirement, it also allows you to bring in more income. Some prefer, if instead of using SPY, they might use SPX, or if they, because that will lower the amount of contracts they're using, so that creates less commissions. The point is that commissions are a necessary evil. You have to basically pay to play. That's how they phrase it. So, but what we're seeing is a stark decline in the commission structure for all these brokers. But to speed up that process, you must negotiate your commission structure. And I've told this to thousands of people and throughout all of these webinars, and I can tell you that no one has ever emailed me and said, yeah, that didn't work for me. It always works. And keep calling and have them continue to lower that commission structure.
And then that alone could save hundreds of thousands of dollars a year for the average person who's trading, Andy.
Oh, and yeah, we're talking. They've done studies on this where they're talking if you added this up over the course of 10 to 20 years, it's a difference of anywhere from 15 to 30% on your overall account. It's incredible. So that's why it's important that you negotiate your commissions fees, because again, they're going to set you up with their flat rate fees, their standard fees.
Great. So is it time for us to do the live trades? I know I'm getting some questions from folks who are saying, when are we doing the live trades? When are we doing the live trades?
Yes, we are getting to the live trades right now.
Great. So why don't I do a quick poll question while you're setting up to the trading platform? And I just want to let everybody know that we get this question all the time. What trading platform does Andy use? What are we looking at? What you're going to be looking at is this is the Thinkorswim trading platform, which is from TD Ameritrade. So TD Ameritrade is the broker. We don't have any business relationship with them. We don't endorse them. It's just the one that Andy personally likes to use. So that's what you're looking at right now. Is TD Ameritrade, the Thinkorswim platform. It's great for options. Calculates things like probability of success for you, so you don't have to do it on your own. So it's pretty simple. So let's do a quick poll. What is your biggest concern about trading iron condors? So again, what's your biggest concern about trading iron condors? Is it that they appear to be confusing? Is it that you don't have enough capital? Is it the cost of trading commissions? Is it that you just don't think you have enough time to be doing this strategy? Or is it that they seem risky and you're worried about losing money? So give me a quick vote. I have about 22% of people voting in this poll, and you guys know I like to see at least half of you guys replying. So give me a quick vote. Again, it's just a quick poll on your screen. You're just going to select one of those buttons that's the answer that you want to select, and then just click the submit button. That gives me the response, and we'll close that down and get to the live trade. So a few more votes, and then we can do the live trade. So come on, guys. Give me a quick vote in that quick poll, and we'll wrap it up. So Andy, let's turn it over to the trades. I think now is the right time for that. So I'll turn it back to you.
Yeah, thanks, Ian. So we're going to go over 3 trades. We're going to start out with
Andy, you're cutting out there. Are you there, Andy? Are you there, Andy? Andy, we can't hear you. Are you there, Andy? So anyways, Andy will be back in a minute. It sounds like we're having some sound problems there. So Andy,
Can you hear me?
Andy, yeah, are you there?
Yes, I'm here.
Okay, great. So Andy's back. We couldn't do that without you, Andy, because I'll tell you, you guys would not want to see me making these trades on my own. I think I'd screw it up, and you would definitely lose a lot of money. So I'm glad Andy's back. So Andy, you're here. We can hear you. Go ahead, Andy.
Yeah, thanks, Ian, and my apologies. We also can't do a webinar unless I make some type of technical flub, and unplugging the microphone would be considered a technical flub, I suppose.
Great. Let's do it then.
So anyway, let's get to the trades. We're going to start out with that same SPY trade that we talked about before, but we want to do this on the live platform so we have some type of comparison. So basically, SPY is now trading, as I said before, it's trading for roughly 243. we're going to go out to the August expiration in 58 days, and we're going to look to trade. So the first thing that we do, we're going to go to that at the money strike, and that's going to be 243. So we're going to scroll down on the platform. And what we're seeing is the 243. Now we're going to go over to the probability at the money, or out of the money, and we're going to move up to the, let's say, the 250s. Now the 250s have an 84.3% probability of success. Now on the other side, the put side, we're going to go down, we're going to basically do the same thing. That at the money is the 243. We're going to go all the way to at least, let's say, the 230s. So our range is established. We're going to sell our short strikes at 250 and 230. So we have a range of 20. So basically SPY can float around that 20-point range and just sit there and allow time decay to erode as we move closer and closer to expiration, which in this case, as you can see, is in 58 days. But remember, we're taking this trade off. The plan is to take this trade off anywhere from 30 to 45 days. Hopefully even sooner than that. So we're going to sell at Iron Condor. Again, we're selling that 240 call strike. We're going to go 3 strikes wide on this trade. So we're going to buy the 253. We're going to sell the 230. And we're going to buy that 227. Again, the reason why we buy the option on the call and put side is that defines our risk. So by doing so, we're going to be able to bring in roughly 63 cents. So basically what happens is that our break even is now 250.63, and on the call side and on the put side, it's going to be 229.37. So, and our return on the trade, since we're able to bring in 63 cents, it's going to be 63 subtracted by, since we're going 3 strikes wide, subtracted by the 3. That's going to give us 237. So we take 63 divided by 237, and that's going to give us a 26.6% return on SPY. And again, we're able to bring in $63 per Iron Condor spread. So that's the first one. And as you can, let's see if I even have this on the chart. As you can see, we sold that 250. On the 230, so as long as it floats between those blue lines at expiration, through expiration, we're going to receive a max profit. But as I said before, we typically take the trade off once we're able to reap 50 to 75% of that original premium that we sold. And one other thing that I want to point out, because I went over this earlier, but I want to show this on the platform. Now, to receive a max loss, you actually would have to go in the monies. The underlying ETF, that being SPY, would have to push in the money. So that means that there is a 13% chance that SPY pushes below that 227 strike, and that would mean a max loss, or there is a under a 7% chance that it's going to move past that 253 strike on the upside. So as you can, but the thing is we also have the ability, because Iron Condors move so slowly, if we start to see a $2, $3, $4, $5 move in one direction, we can manage, we have the time to manage a trade. Unlike if you're buying an option where it's really difficult to manage a trade with any type of sharp price movement, that's not the case for Iron Condors. And if we know that our stop loss, if we bring in 69 cents and we know our stop loss is going to be roughly $1.38 or twice that amount of premium, we have a plan in place, and so we're going to be successful. But again, we have to stay diligent in that plan. So the next trade is going to be in IWM. We're going to go out the same August, 58 days. IWM is trading for roughly 139.5. We're going to start with that. So we're going to start there at the money strike, that 139, and we're going to move to the, let's say, the 146 strike. Has an 84% probability of success, and the probability that it's, and so we're going to go 3 strikes out. So we're going to sell the 146, and we're going to buy the 149. So on the put side, Same thing, we're going to look at the probabilities because, again, it's all about the probabilities. We're going to go down to the 129 strike and see how much we can bring in for this 146, 129 iron condor. So what we're going to do is we're going to sell an iron condor in IWM with 58 days left until expiration. We're selling that 146 call. We're buying the 149 call. We're selling the 129 call, or I should say the 129 put, and we're buying the 126 put. Now, by doing so, we're able to bring in roughly 60 cents on this particular iron condor. So again, we're using a 3-strike wide condor, so it's going to be that we're going to take the total amount of premium, which is 60 cents. We're going to subtract that from the 3, that being the 3 strikes wide. That's going to give us 240. So you're going to take 60 divided by 240. That's going to give us a 25% return on IWM, and that's bringing in $60 per iron condor. So now, as long as IWM stays at expiration between our range of 129 and 146, that 17-point range, that's basically a 12% of the overall price of IWM. So if it stays between our short strikes, or that short call and short put of 146 and 129, we're going to receive a max profit. Now, the probability of taking a max loss on the trade is if it goes through that 149 strike on the call side, which is only 7%, and on the put side is if it moves lower than 126. So the probability of taking a max loss on this particular trade is slightly over 11%. So we really like those odds. Next, we're going to go with the Qs, NASDAQ 100, and it's trading for roughly 140. Same procedure. At the money strike, that's where we start. We're going to go up to, let's say, the 80 percentile. We're going to go a little tighter. So we're going to go at 80% rather than 82 and 84 like our previous trades. That would give us the 146 strike, and then 80% on the other side is going to be roughly 131. So if we were to sell an iron condor, and we're going to sell the 146 strike, and we're going to sell the 149 strike. Again, we're selling that 146 strike and we're buying that 149 strike, and that 149 strike defines our risk. And then we're going to do that on the call side. On the put side, we're selling the 131 and we're buying the, let's see, the 128, thereby defining our risk on the trade. Let's see, 128. We're going to be able to bring in roughly 80, let's say 80 cents, just make it a nice round number. So in this trade, if the Qs stay between our 146 and 131 strike at expiration in 58 days, and we have an 80% probability of success that it's going to do so, we were going to make 80 cents for a return. Again, that's 80 minus that 3 strikes wide, 220. So we take 80 divided by 220. That's going to give us a return of 36.7%. So we would make a 36.7% return if at expiration the Qs close between our range of 146 and 131. That being said, we're perfectly fine taking even 40 to 45 cents. If we took 45 cents out of this trade, we're going to make we're still going to make 17.6%. And rather than waiting 58 days, we might only have to wait 30 days. The reason why I like to go out a little further is because I want to have the ability to increase that range. Because increasing that range is what really, really counts when we're trading these iron condors. A lot of people will go 30 days out in duration. They're not able to take advantage of the expected volatility or that expected range, and it's just not enough time in most cases. Now, there are some cases where we will go 30 days, but in most cases, I like to go out roughly 56 days or so until expiration. So those are those 3 trades. I'll try to get to a few more in the Q&A session if possible, if we have some time. But those are the 3 that I wanted to show you today. Hopefully that helped. That being said, let's kind of move on. Let's move on to the Q&A session.
Yeah, so Andy, real quick, if to make $1,327 with these trades, that was a number that we threw out there. How many contracts would you have to be trading, do you think?
So in order to make, so you'd have to trade anywhere from 5 to 10 contracts per Iron Condor, which falls within the average range of someone using these particular strategies.
Great, perfect. So yeah, so let's get started right now. Andy, I want you to take a couple minutes. I think we're going to X out of the trading platform for a minute. I can still see the trading screen, Andy. Yeah, let's go forward a couple slides. In just 5 minutes, we're going to start the extended. Sorry, Andy, we're seeing your desktop there for a minute. We're going to start the extended Q&A session in just about 5 minutes here. Are you there, Andy? Go
Yeah.
forward one more slide. And so, in 5 minutes, we're going to start that Q&A session. Andy, I've flagged the questions there for you to take a look at. So why don't you start taking a look at the questions? Because I have to be honest, we have a very, very engaged audience today. We had over 2,500, 2,600 people sign up for today's webinar, and the questions have just been outstanding. The engagement of the polls has been outstanding. So I know we have a really engaged audience, lots of great questions. So Andy, start taking a look through those questions. Andy's going to take the time to answer the questions that you have about Iron Condors. He can go back to the trades that we showed you. We can actually show you how you do an Iron Condor on something that you might be interested in trading. If there's a stock or an ETF that you're interested in trading, we could look at that too. So we're happy to stick around and answer any questions. Before we do that, though, I want to briefly invite you to join Andy's Inner Circle. This gives you a unique opportunity to continue learning new options income strategies, including Iron Condors, and gives you an opportunity to trade right alongside with Andy. And so with that, I'm just going to take the next 5 minutes to talk to you briefly about Andy's Options Advantage and all of the benefits that are available and a unique offer that we have available for webinar participants today. And then we'll get right back into the Q&A and talking about trades and going back to the trading platform. So what is Options Advantage? Well, Options Advantage is designed to give you the complete options trading solution. It's here to show you exactly how to use Iron Condors to earn more income every single month and how to consistently beat the market. This really is the fastest way to start implementing Iron Condor trades in your portfolio. This portfolio is brand new for 2017. It's an exclusive trading portfolio, 100% focused on Iron Condors. Andy's making 2 to 5 trades per month, targeting gains of 8 to 25% per trade. It is his premier options trade alert and training service. With it, you're going to get live and real-time coaching and access to Andy and his trades. Those coaching sessions happen in small, exclusive members-only webinars. And he's also going to provide you with access to his training materials, including special reports and videos, all designed to help you be successful from day one. If you want to learn how to use Iron Condors and do it yourself, the Options Pro Quick Start system gives you over 10 hours of exclusive training videos that are designed to help you get started. It's a $999 value and it'll be yours for free. Additionally, Andy has prepared 5 special bonus reports with this offer, including Andy Crowder's complete guide to options profits. The second report is called 3 Simple Option Strategies for Earning Extra Income Without Taking Big Risks. The third report is called The Vital Rule for Every Options Trade. The fourth report is called 3 Options Trades You Can Make Right Now. And plus the 5th report is all about Iron Condors. It's called Iron Condors, a step-by-step approach. So all 5 of these reports are yours as well. Now, if you're someone who says, look, I'm interested in learning how to use Iron Condors, this is the best way to get started because the special reports, the training videos, and the live members-only webinar training sessions are designed to help you be successful from day one. If you're someone who says, look, Iron Condors sound interesting, but I just want to see what Andy's trading, well, Options Advantage is also going to be perfect for you because with Options Advantage, you're going to get trade alerts at your convenience, sent out via email, SMS message to your mobile phone, as well as members-only website access. Now, just to be completely clear, you do not need to be a day trader to be using these strategies. You can execute these trades at your leisure. You're never going to be tied down to a computer. Now, one of the great things about us is that we're a small company, and that means we can give you direct access to Andy, as well as live support by a team of 4 client success professionals who are committed to helping you be successful. They're here from 9 a.m. until 5 p.m. Eastern time. I've put up our phone number as well. Now, you're probably asking yourself, how much is all this going to cost? Because this sounds pretty amazing. And I'll be honest, the normal annual membership to Andy's Options Advantage is $3,950. After spending 5 years creating the service and using these strategies for more than 20 years, Andy knows that it's worth every penny of that. And some people are paying nearly $4,000 to access this information. The Options Pro Quick Start system is also valued at more than $1,400. But here's the good news. It's going to cost you a small fraction of those figures, because right now we're opening the doors with a premium package for just $1,995, which doesn't give you 1 year of access. It doesn't give you 2 years of access. It doesn't give you 3 years of access. It gives you 4 years of unlimited access, which means you're going to be paying the best available price of the equivalent of just $10 a week. You're going to be saving 87% off the normal membership price. You'll immediately get access to Options Advantage plus Andy's Options Pro Quick Start system. Now, maybe you're looking at this and you're saying, look, that's a lot of money. I'm not sure I'm ready to make that level of commitment. And if that's the case, it's okay. We still have a great deal for you. Right now, we're also offering a 1 year membership for just $995, which equals $19 a week. You're still going to save $2,955 off the normal membership price, and you'll get access to Andy's Options Advantage and the Quick Start system. Plus, remember, you're going to get so much more. You're going to get access to Andy. He's going to be your coach and mentor, showing you how to consistently beat the market. Top trading coaches often get paid $200, $300, $500 an hour. You're not going to pay any of that because we don't sell Andy's coaching services. It's included with your membership to Options Advantage. So to sum it all up, there's no better way to get started with iron condors and trading options for income. With Options Advantage, you're going to get 100% access to the 15 to 20 live trade alerts per month. Using these strategies, you could start winning 80 to 90% of your trades, earning annualized gains of 20 to 40%. So again, Options Advantage is now open. You're going to get the live trades, SMS, email, text message alerts, complete access to Andy, and live support by my team. So here's what you need to do right now. You need to go to my website, www.optionsadvantage.com. I'm sorry, www.tryoptionsadvantage.com is the website. Again, www.tryoptionsadvantage.com. That URL will take you directly to the offer that's online right now. So again, I'm going to leave this up for just a minute, and I want you to go to the website and check it out right now. Go online, www.tryoptionsadvantage.com. That'll take you to my secure website. And so, Andy, maybe why don't you go ahead and type that URL into chat so everyone has it. When you get to that page, you're going to see a web page that says, simple strategy for earning 85% in 2017 with only 11 trades. Again, this is what Andy has already done in the first in the first 5.5 months of the year. We believe that the summertime is one of the best times to be trading these strategies, and we want to give you complete access right now. Real quick, and I know we're getting ready for the Q&A. Andy just sent me a message saying he's ready to answer your questions. I want to let you know about a special gift that we have available for those of you who join us on the premium package today. So here's the deal. We have a gift box for you, and I'd love to send it out to you this week. So this is what it is. You're probably wondering, well, what's inside this gift box? Well, here's the deal. Right now, we're opening the doors, and you're not only going to get access to Andy's Iron Condors strategy, but you're also going to get access to 4 additional trading portfolios. Each of these portfolios is a $995 value. So you're going to get credit spreads, selling puts, weekly options, and the FANG options portfolio as well. You can expect a total of 15 to 20 trades per month. Again, each of these portfolios are a $995 value, and this is yours free with your Options Advantage membership. Additionally, we're going to send you a copy of Understanding Options. This is the 2nd edition. Andy says it's a great primer for any options trader. It's ranked 4.5 stars. It's normally $21, and it's yours today, absolutely free with your premium package. Again, these are a couple of the reviews. These are just reviews from Amazon. These aren't editorial reviews or newspapers or magazines. Good book for the beginner. Learning about options. This book was a big help. Easy to read. Valuable points of guidance. Enjoyed reading through this. So again, that's available to you right now as well. Your third bonus is a book called Trading in the Zone: Master the Market with Confidence, Discipline, and a Winning Attitude. This is focused on the mentality of trading success. It exposes some very big market myths. This book will help you get in the winning mindset. This book is normally $60, but again, with your gift package today, it's yours completely free. And again, these are some of the reviews from Amazon. Top 5 trading book for all types of traders. I've seen a list of trading books, and this was on the bottom. I put it at the top of the list. We have another review. Awesome book. Really hit the nail on the head. Speaking of the head, it all starts here. Trading game is a head game. Then we finally have The Devil's Financial Dictionary. This is a fun book that Andy and I decided to throw in. It's written by a columnist, Jason Zwig, who writes for the Wall Street Journal. This is a great book. It's really fun. You're going to love it. It's all about myths and scams on Wall Street, and it's just a great, great read. You guys will really like it. So we're going to throw that in as well. And finally, the 5th bonus here is a book called Market Wizards Updated, Interviews with Top Traders. This is known to be one of the best books for traders. Interviews with top traders and money managers who've made 30% annual gains. Another trader turned $30,000 into $80 million. This is full of their stories and a lot of insights here that I believe could really help you. So this book is a $27 value. It's going to be yours free too. Here are a couple of the reviews on this book. It says actually one of the best books about trading. Another one says it's Magicians of Wall Street, essential for every new trader. And let me tell you, I guess actually wait, one more thing. So we're going to throw this into, we have the Wyatt Investment Research flash drive, which is the options income training package. So we're going to send you a flash drive as well. It includes 5 exclusive training videos with Andy, plus 5 bonus special reports in PDF. You're going to be able to download those from this flash drive that we're going to send you as well. This is available too. And right now, I just want to let you know, we have only 50 premium packages available, only available to webinar participants until 2 p.m. today. The 5 extra trading portfolios are nearly a $4,000 value. The 4 bonus trading books are a $128 value. It's all yours right now. This is what it looks like. I put it out here on our table here. This is what you're going to get. You're going to get a confidential envelope with your special reports. You're going to get the flash drive. You're going to get the 4 books that we discussed, plus the a deck of trading cards, investing tips that we actually put together with tips for traders, tips for investors. So you're going to get all of this right now. It's available. Here's our website. So Andy, jump in right now. I know you're pretty excited about this package, and you actually hand selected all these books. I said to you, Andy, I want to send out gifts to new Options Advantage members to welcome them to the service. I said, Andy, what do you want? What do you want to give them? And this is what you picked out. So tell us a little bit more about your thought process as you sort of selected these gifts for our members.
Yeah, I think the books are all a great read, and they're all very helpful. That being said, the most important piece of all this and where the true value comes from all of this is the fact that you're learning a new type of strategy, a new type of income strategy. Not only that, but you're going to have access to me either through the phone, like through phone calls if you have questions, or through email, so you have direct access to me. That alone is where, in my opinion, is where the value of this service lies. Because again, we've had a lot of success with the strategy. It's a strategy that most professional options traders use. So just having the benefit of using an income strategy that creates consistent profits if used properly, and if you have that plan and if you follow the plan that we use within the Options Advantage service, you're going to be successful. But not only that, you also have access to 4 different option strategies, as we've talked about, and that's important because you want to diversify amongst a variety of different option strategies over different types of durations. Again, these are all of the things that we talk about within the Options Advantage service.
Great. So again, our website is open. We are now accepting new members. I want to get these gift boxes out. So again, it's www.tryoptionsadvantage.com. Go to that website. That website alone is going to take you to the secure order page where you can claim your gift box today. Claim your 4 years to Options Advantage right now. It is available. And let's go back. Actually, go back to that slide because I want to give people a phone number too, because we always have people who want the phone number. You can also pick up the phone and call 802-448-4881. That's the local number. Toll-free number is 888-875-1960. Again, 888-875-1960. Give us a call. We'd love to chat with you. I know Andy and I are around. We're happy to get on the phone with you. My team of client success professionals are also here to help. We'd love to get you enrolled right now and help you get started with Options Advantage. This really is an amazing deal because you're going to get 4 years for the price of 2, essentially. So again, this is everything that you need. And the quick start guide, the quick starts with, let's go back one slide, Andy. The envelope, which is going to include the special reports printed out. You're going to love those. You're going to be able to page through them, take notes on them. It's awesome. You're going to love the 4 books that Andy selected. One of them is a fun read, just to have a little bit of fun. The other 3 are really going to help you become a better, successful, more successful trader. And of course, we're going to send you the flash drive, which includes the videos to watch. So you can watch them at your convenience. You can also have the special reports there in PDF as well. So again, that's everything that you're going to get. We're going to send it out to you. Our website is www.tryoptionsadvantage. I want to thank Bruce Foster, who just joined us. Bruce, welcome to Options Advantage. I want to thank Carolyn. I want to thank Thomas and Judith. I want to thank Alicia, who just joined us. Alicia Watkins. I want to thank Mike Lundquist. I want to thank William Simmons. I want to thank Kurt Griggs. I want to thank Charles Herbert. Welcome. So much interest in this initially from new folks deciding to take an important next step with Options Advantage and trading with Andy. Now, I want to let everybody know that we are offering this special gift bonus now for the very first time. We're only enrolling 50 new members. We had 2,603 people sign up for today's webinar. We had just under 1,000 people joining us live for today's event. So we certainly had a ton of interest today. This was record attendance for one of these Iron Condor events that we've ever held. So very excited about this, and it looks like people are pretty interested. I see, Mike Gallagher just joined us. So did Don S. Don S., welcome to Options Advantage. So pleased to have you here. And it looks like the website traffic is just soaring, Andy. It's just crazy. Like I see 203 people on the website right now looking at this. So, if only 25% of them decide to take us up on this offer, I think we're going to be 100% full within the next few minutes. So, real quick, let's see. Looking through this, I'm expecting that we're going to be sold out within 24 hours. Again, the premium membership gives you access to all the bonus gifts. It's only $1,995, less than $10 a week. This includes not 1 year of access, not 2 years of access, but 4 years of access. You're going to lock in an 87% new member discount. And this is going to be the last time that we're offering this amazing price. We're not going to do it again. So if you want access at the best available price, I need to get you enrolled right now. So tomorrow morning, 8 a.m., I'm sending this out to 320,000 people on my email list. They're going to be offered the same discount. I expect will fill up as soon as that happens. So again, let's put up the website. It's www.tryoptionsadvantage.com or 802-448-4881. So Andy, I see there are a ton of questions here, right? You ready to get over to the questions?
Yeah, definitely.
So let's before I'm going to turn it back over to you. I want to say, this is a question that I see all the time, which is, why should I join Options Advantage? And I'll say this. This is perfect for traders who want to start winning at least 80% of their trades. It's perfect for traders who want to use professional options trading strategies. And it's perfect for traders who want to earn extra income every month no matter what's happening in the market. Now, another question that I get is, who shouldn't join this? Or, should I join this? I get that all the time. Should I join this? Is this right for me? Well, let me tell you. If you're someone who only has like $500 to invest in the market, this probably isn't right for you. If you're just getting started and you've never invested in anything before, you've never bought a stock or traded an ETF or anything, this is probably not the right place for you to start. If you're someone who's looking to double your money in the next 3 months, this probably isn't right for you. So if that describes you, this probably isn't right for you. But But if you're someone who says, look, I have been trading and I want to get better at trading and I want to learn new strategies and I want to work with a coach and a mentor to become a better trader, then I think this is right for you. So let's talk about the track record, Andy. Do you want to walk us through the track record? Because again, I get this question all the time too, is that, how has this really been doing? Show me the trades. So we don't need to discuss each of them individually, but at a high level, what's been going on here?
So basically, these are the trades that we've placed this year within the Iron Condor portfolio. And as you can see, we've been in these trades. Again, we launched the Iron Condors portfolio back in January of 2017. And the results are we've had 11 closed trades, only one loser. As you can see, we kept that loser down to 11.5%. Our win ratio is 90.9%. Average gain per trade is roughly 8.7%. And our return on capital is 85%. So we've had a very good year. It's kind of worked out as planned. You can start to see the amount of income that we're able to bring in. And again, we're not going for home runs here. We're simply shooting for small, consistent gains on a monthly basis. That's the key to using this Iron Condor strategy.
So let's put up the next slide because I think this shows the overall results that people are interested in. Andy launched the Iron Condors portfolio in January of this year. Since then, he's made 11 trades. So on average, 2 trades a month. Only one of the trades has been a losing trade. That means the win ratio is 90.9%. So we'll round it up to 91%. Average gain per trade is 87%, and the return on capital is an astounding 85%. So that's pretty amazing. When I talk to people, I'm like, look, in the first 5.5 months, you could, earn return on capital of 85%, make 8.7% per trade, only lose one trade. It just makes a ton of sense for folks who want more consistency with their trading results. So again, here we have, a list of that. Let's see. Yeah, so again, this sort of shows the average 8.7% per trade in a duration of 23 days. So that's pretty amazing. And I want to answer, this is a common question, I hear from people, is my satisfaction guaranteed? And the answer is yes, your satisfaction is guaranteed. If you're someone who's here today, you're asking for a refund before you've even tried Options Advantage, it tells me you might not be that serious about trading, and you might be sort of going into this expecting failure, expecting not to be successful. And if that describes you, then I'd prefer that you not join us at Options Advantage. But let's face it, there's a lot of BS out there, and Andy and I want to prove to you that this can work for you. So we are 100% happy to guarantee your satisfaction. You can join us today at Options Advantage, and your satisfaction is guaranteed for the first 30 days. What this means is that you can sign up today without any risk. You can try Options Advantage for the next 30 days. See if it's right for you. If at the end of that 30 days you say, look, this wasn't great, it's not for me, I tried it, but it's just not the right strategy, Andy's special reports weren't that helpful. If that happens, give us a call and we'll refund every penny. We'll refund all of your money for your Options Advantage membership. So essentially you have 30 days to get the videos, watch the videos, download the special reports, read the special reports, look through Andy's live trades, attend a members only webinar, maybe do some paper trading, see if this is right for you. And if at the end of that 30 days you're not happy, give us a call and we'll refund every single penny. On that satisfaction guarantee, which Andy and I stand behind, I'm comfortable doing it because I know there's like a 90% chance that you're going to be psyched, you're going to be happy with Options Advantage, you're going to stay with us for the long term. So if you're on the fence and you're saying, well, I don't know if I want to do it or not, I'm hoping that by guaranteeing your satisfaction, I can convince you that this might be the right thing for you and that now is the best time to get started with this Iron Condor strategy. So Andy, I know that one of the questions that we get from people, and I'm seeing this right now, is how does this strategy work in this summer? And let's move right over into the question and answer, because that's one question that I'm seeing a lot of. Let's go ahead and just put up our website right now and the phone numbers, and we'll come back to sharing some sort of some client success stories in a minute. Let's get into the questions right now. So Andy, why is the summertime such a great time for this strategy? Are you there, Andy? I think maybe he's muted.
No, I'm here. So summer's good for as a great time. Really, any time is good to learn. iron condors because, again, this is a long-term strategy. It's a strategy that you want to use consistently over the long haul, month to month, bringing in consistent gains. The summer is a good time because we often fall into what's known as the summer doldrums, where we typically trade within a range. The market because most move away from the markets during the summer, and that being said, volume has declined in most cases, and that basically means that we have this slow drift where we're just kind of moving sideways over the summer. So it's a great opportunity to start an iron condor strategy.
Great. So Andy, let's go ahead and put up the website with the URL because I want to encourage people to go there right now, and the phone numbers. And let's turn over to questions. I want to do some questions. We'll come back to the client testimonials in a couple of minutes. Let's get into some questions because I know we've had folks who've been waiting here for questions for quite some time.
Yeah. So okay. So let's start with all right.
You see, I flagged some questions there. I don't know if you see them. I see.
Yeah, I was looking at one, and then okay. So here we go. So basically, we have a question. When you say you close early, what does that mean? So basically, if I sell a spread, an iron condor spread for, let's say, our original example in SPY for 70 cents, I like to close that early to lock in profits and then limit my exposure to the overall market. As you can see, we've averaged about 23 to 24 days on a per trade basis, and we've been able to lock in about 9% per trade. While I'd like to bring in a little more, I'm perfectly happy bringing in 9% for every single trade because I can tell you that adds up, and it adds up quickly. Let's see. Debbie asks, the problem is if you're bringing 40 to 50 cents in, then you add commissions. So that eats into a lot of your overall return. Commissions in Canada are hopeful. I love iron condors, but it's difficult if you have a smaller account, and that is the case. If you do not negotiate your commission structure, and that's if you're trading let's say one contract, or if you're bringing in, let's say, a premium per iron condor of, let's say, 10, 15, 20 cents, so you're going way, way out of the money, then this doesn't make sense. But if we're able to bring in 70, 80 cents per condor, or even 50 cents, and we're trading a substantial amount of contracts, 3, 5, 10 contracts, where commissions aren't going to play near the factor as if you were to just trade one contract. And the reason why that is because you typically pay that base price just to get into that overall trade. And that base price is the same if it's one contract or 100 contracts. That being said, if you're shifting over to brokers like Tastyworks or Options House, in most cases, you now have brokers that aren't charging to exit a trade. You're paying $1. So going back to that example, rather than paying the $14 in total, you're now paying, if you were to go to a broker like Tastyworks, you're paying $4 to get into the order and nothing getting out of the order. And the reason why that is because they understand the importance of taking the trades off early. They understand the research and the advantage of taking those trades off early and then moving on. And that's why more and more brokers are offering more competitive commission structures. Tastyworks is kind of leading the way in this, but other brokers are going to follow. And I can tell you, if you call and negotiate, because I recently called a couple brokers and asked them about this, they are more than willing to negotiate with you, but you have to make the phone call.
Yeah, and Andy, I saw a couple comments from people who said they tried that and they couldn't get it, but it sounded like maybe they hadn't started trading yet. So just to be clear, if you aren't currently actively trading in your account, and you just buy and sell a couple stocks a year, the brokerage firm isn't going to give you a discount for that. They certainly want to see you as an active trader in your account before they might be willing to talk with you about their fees there. So again, I want to encourage people, let's go online. Go online to the website www.tryoptionsadvantage.com, or pick up the phone and give me a call right now, 888-875-1960. Andy or I are happy to get on the phone with you personally and talk with you, answer any questions if you have them. So give us a call right now, 888-875-1960. We're happy to have a one-on-one conversation with you to talk a little bit more about this strategy. We'd love to hear from you. We'd love to get you enrolled. And the best part is that you can start winning more trades. You can start winning 80 to 90% of your trades. You can start doing it right now. You can try it 100% risk-free. So you can sign up today, download the special reports, watch the training videos, get your gift box in the mail, get the 4 books, get the deck of cards, which is really fun. You can get everything. You can attend Andy's upcoming members-only webinar. You can paper trade Andy's trades. You can look at the track record. You can do all of that for the next 30 days. And in a month, if you're not happy after doing all that stuff, you say, look, actually, I changed my mind. Or actually, my spouse doesn't want me to pay the money for this. Or, you know, I decided I don't want to trade anymore. Or I decided I don't want to earn more income. Or I decided I don't want to, you know, win 80% of my trades. I decided I don't want to do any of that. So if you just give us a call and you're going to say, hey, look, guys, this wasn't for me. Can I get a refund? And we'll say, sure. Yeah, we'll give you a refund in full, no problem. You'll get your money back, and you know, we'll part company, and that's totally fine. You know, I know that this day and age with the internet and everything, there's a lot of junk out there, and so I want to encourage you to, you know, feel comfortable making a decision with confidence that this might be the right thing for you. So, again, if you're on the fence, I want to let you know that, you know, we can eliminate any of that potential risk that you might have, or any of those things that are going through the back of your mind, like, should I do this or not? Obviously, we have the premium package available, and we also have the 1 year available as well. The 1 year is an amazing deal as well. So I'd love to get you enrolled right now. It's www.tryoptionsadvantage.com, or give us a call at 888-875-1960. So let's get back to the questions, Andy.
Yeah, and so what the free trial actually, you know, in my mind, the reason why we do the 30-day free trial is not only are you're able to educate yourself through the reports and the videos, but the most important piece is that you're able to email me or call me with any types of questions that you have within that 30-day time frame, and that definitely helps steepen that learning curve, and it gives people some direction or some things to think about regarding the strategies. So that in itself, I feel as though where that 30-day trial period kind of, you know, that's the benefit of that 30-day free trial period, because it really allows you to get familiar with the approach that we're using within the Options Advantage service. So let's get back to the questions. BC asks, how do you adjust or fix if a big move into short strike, say between 60 and 30 days left? So BC, what we do is, let's say if the underlying stock, let's use SPY, and we'll use that 250, 230 trade that we had, that being the 250 call strike, 230 put strike. Those are the short strikes. So it was trading for 243. If it moves up to, let's say, 250, we know that the put side has decreased in value, which is a good thing, because the underlying stock, or in this case ETF, has moved higher. So what we do is, rather than roll the call side, we want to actually roll the put side and roll that put side higher. And the reason why we do so is because we can bring in more credit. And by bringing in more credit, we've increased our break-even level. We've increased the amount of credit on that particular trade, so that's reduced our risk significantly. But not only that, we also account for what mean reversion. So if something has moved in a very short period of time to, let's say, from 243 to 245, it's in most cases moved at least 1, if not 1.5 standard deviations away from its mean. And as we all know, mean reversion will kick in, just a matter of time. That's why we go out as far as we do. And so, once that kicks in, if we've made that adjustment, we are able to take that spread off for a small profit. But that's how we handle any adjustments. We don't necessarily want to roll up the side that's tested. We want to roll the side that's untested. And that's something that most professional options traders do. Most newbie traders do it the exact opposite. They roll up the tested side, and you will quickly find out that that's really difficult, because what you want to do is you want to give yourself more time for your trade assumption to kind of take form. So when we adjust, if it's early enough within the expiration cycle, we'll just adjust within that same month and just roll up the strikes. Now, that being on the put side. Now, if it's closer to expiration, let's say we have 2 or 3 weeks left and our trade starts to look like it's in jeopardy of taking a loss, and if we definitely want to make that adjustment, we then roll out in duration. That means we just go out to another expiration month, thereby giving us some time for that trade to work for us. Now, another question that kind of follows that up, and this is from Annie: if this trade goes against you, when will you take this off? In an Iron Condor, I basically take it off when it's double the amount of premium, roughly double the amount of premium that I bring in. So let's say I'm able to sell an Iron Condor for 80 cents. I'm going to get out of it for $1.60 because I know in 1 to 2 trades I'm going to make up for that and then move forward. Again, it's about allowing the probabilities to work in your favor over time. It's about increasing that sample size, not 10 trades, but to 20, 30, 100 trades, allowing those probabilities to work themselves out and reaping those profits and making that equity curve as consistent and as smooth as possible. We do not want to take huge drawdowns because, again, huge drawdowns are detrimental. But that's the other piece that I went over. The best way to avoid huge drawdowns is to have a consistent position size. That is important. So all of the things that I talked about, all those pieces are imperative if you want to be successful trading Iron Condors or really any options trading strategies. Let's see. Peter asks, what is laddering the trade? So basically, laddering the trade, a lot of people do this for bonds, particularly those that are seeking income, consistent income. So basically, you're making a trade every 2 weeks or every month, knowing that you're going to reap some form of income or profit every 2 to 4 weeks. You're locking in profits, moving on to the next trade. So we're trying to make trades every 2-3 weeks or so. And we're trying to ladder those trades so we have a consistent, steady source of income coming in through this Iron Condor strategy. That's the benefit of using these types of strategies. Let's see, Mike Mill, how do you calculate the 5% position size when you have with initial credit on each Condor? So basically, I just use 5% as an example. Because it was just easy to see. You can use 10% if you wish. You can use 15%. I prefer to use 5% or less, but it really depends on your overall, the overall amount of capital that you have dedicated to your trading account. And you have to do what makes sense. You just want to make sure that if you have a losing trade, and that being a losing trade where you take it off at its appropriate stop loss, that it's not going to be detrimental to your overall account, because you want to be able to to allow those probabilities to work themselves out. As I said before, if you just went out 10 trades, research shows that your variance is going to be anywhere from 3 to 7. That's the same, if you're flipping a coin, it doesn't matter. Your variance is going to be 3 to 7 on a sample size of 10. You have to give yourself time for the probabilities to work themselves out. And the only way to do so is to keep your stop losses at a reasonable level and to use proper position size, whether that's 5%, 10%, it doesn't matter. You have to have a plan in place. That's what matters, and you have to be consistent.
Andy, can I just jump in here? I know
Yeah.
we still have hundreds of people here. Again, I want to thank Christine Waknov, who just joined us. I want to thank Don S., who just joined us. I want to thank Mike Gallagher and Richard, who just joined us. I want to thank Bruce Foster, who just joined us. So welcome, guys. Welcome to Options Advantage. So pleased to have you on board. And I want to encourage everybody else who's here. Go online, grab your spot, www.tryoptionsadvantage.com. That's our website. Or pick up the phone and call 888-875-1960. Jake and Scott are standing by. They just got off the phone after helping enroll 2 brand new members. So go ahead and give a call. They're available to chat. And obviously, if you need to speak with Andy or I personally, we are here and we can speak with you this afternoon. So give a call. Talk with Jake and Scott. Get the process going right now. Andy and I are standing by. We will be happy to take your call live this afternoon if you'd like to chat, if you have any questions about this. So again, call 888-875-1960 or go online. And Andy, I want to ask our audience, are there trades that you want us to look at? We can go back in and do some Iron Condor trades on some of your favorite stocks or ETFs. So if there's something that you want us to trade to show you again how to do this, we saw that, a lot of folks said that one of their biggest concerns about this strategy. Um, you know, yeah, so Andy, look at this. 32% of people say their biggest concern about iron condors is that it appears to be confusing. So I'd really like us to help make it seem less confusing for people. So if anybody has a stock or an ETF that you want us to do an iron condor trade on, type it into questions. Give us the ticker symbol and the name of the security, and we can go ahead and we can actually fire up the trading platform again and do some more live trades. So related to that, Andy, Kobe has a question. Do you mainly only select ETFs on indexes and not on individual stocks? So, what works better, ETFs or stocks for this type of strategy?
For the Iron Condor portfolio, I stick with ETFs, and the reason why I do so is because they're inherently diversified. So we don't necessarily want any news-driven announcement or something like that to affect our Iron Condor, because again, we're trying to bring in it's about bringing in consistent income. That being said, I have another portfolio which we mentioned, which is the FANG portfolio: Facebook, Amazon, Apple, Netflix, Google, and I will trade Iron Condors within that portfolio, and that's on individual stocks. Because those particular stocks have a higher implied volatility, I'm able to go out. I'm able to increase my range significantly. So, but it's still shooting for those same types of gains, small gains when I'm using Iron Condors. Stan asks, I've traded Iron Condors, but almost every one of them have lost money. Do you know how to adjust them when they move outside of the strike zone? So, Stan, okay, first of all, I would imagine that you are using Iron Condors with a lower probability of success, probably lower than 68%. You want to be at least one standard deviation away from the mean, and that's using probabilities that are at least higher than 68%. My preference is to use higher probabilities. That's why why we phrase these strategies as high probability options trading strategies. This is how most professionals approach Iron Condors. They fall within that 68% to 80 to 85% range. So if that's the case, just based on the probabilities, you should not be losing the majority of your Iron Condor trades. So first of all, maybe your range is a little too tight. Secondly, you do not want to wait until your strikes have been breached before you make adjustments. Because in most cases what has happened is that your premium has already doubled, if not tripled. That being, let's say you sold an Iron Condor for 50 cents, it's most likely moved up from $1 to $1.50 if it's moved past your short strike and it is coming close to even your long strike. So you want to start with a larger range, and then you want to use proper position size, and then you want to use that stop loss that's basically around 2 times the amount of premium that you bring in. What most people don't realize is that adjustments aren't that people think that you need to adjust when using option selling strategies. I can tell you that most options professionals rarely adjust because they understand the risk that's involved. What they do is they limit their position size and they take that stop loss once it reaches, basically twice the amount of premium that they're able to bring in. Because what adjustments do is that you're locking in a loss and then you're just exposing yourself to more risk by essentially taking on a new trade. Now, if you think and you believe that that stock is going to still do or that ETF is still going to do what you planned on it doing when you originally made that trade, then by all means that adjustment makes sense. But in most cases, and this is why most professionals do not adjust, which most new traders and even intermediate traders don't quite understand, is because they already have a trading plan in place where they're using proper position size, because they also understand the math behind what we're doing and allowing those probabilities to work themselves out. Let's see. Let's keep going through these questions.
Yeah, and then maybe we could do some trades, some more trades. Yeah. I see. Did you answer Hugo here? He says, how do you limit losses? Did you already answer that one?
Yeah, I answered that. Let's see. Yeah, Jeff, technical flub. It was definitely an operator error. Um, let's see. BC, is there any advantage of using probability or percentage out of the money versus in the money, or just personal preference? You want to use out of the money because that's going to give you your probability of success on that particular trade. You can simply use in the money if you want, subtracted by 100, and that's going to also give you a probability. It's basically an inverse relationship between out of the money and in the money. Now, those that do not have access to out of the money or the probability of success on their platform, another easy way to do this is to take the delta, which I'm hoping that all of you have on your platform. If you do not, you probably need to change platforms because your broker is not option savvy. Then you simply take that delta and you subtract it by 100, and that's going to give you your probability of success on that particular trade. And it's a margin of error of anywhere from 2 to 3%, but it's a very good way to gauge what the probability of success is on any given trade. Again, that's just taking 100 minus the delta. That's going to give you your probability of success. Let's see.
I see
So
Raymond here is asking, could you go over the 3 trades from this webinar again, just to be clear? Raymond, we're going to send out the video replay, so you could rewatch it, I think. I don't think we're going to go through all 3 trades again, unless you wanted to, Andy.
well, we can definitely go through a couple trades. We'll go through a couple different trades because, like you said, you can always watch the presentation again if you want to go over those. Mike asks, it looks as though on most occasions use 2 strikes. Today Andy is mentioning up to 5 strikes wide. So that's a slight change to what we're doing within the Iron Condor portfolio. We have been using 2 strikes, although we have used 5 strikes on occasion in the Fang portfolio. And what I want to do is I want to start introducing 2 strike. I want to keep that 2 strike wide spread that I've been using, but I also want to introduce 3 strikes wide and 5 strikes wide, just so people can start to understand how these work. Not only that, but it also makes it easier for those with smaller trading accounts to use a wider spread. Now the risk is it's going to require more of a maintenance requirement, but the overall risk, if you stay consistent, is going to be the same. There's no difference. The only difference is that you're going to be able to bring in more premium while your maintenance requirement is going to require a little more. But most professionals like to use anywhere between 2 to 5. Some guys will go use what they call a big boy Iron Condor, and that's where they go 2 strikes wide in their spreads. And what that does is that allows you to bring even more credit in, or you have the ability to also widen that range. Let's see. Susan, Andy always shows how to sell an Iron Condor to open. Can he show how to close it 30 days before expiration? So Susan, I can do that, but all you're doing is you're just doing the reverse order. So if you buy to open a short call strike, you're going to sell to close. If you buy to open, or if you sell to open, you're going to buy to close. It's just the exact opposite order. That's how you close out an Iron Condor. It's very, very simple. So Robert says, Andy, why not go for a probability out of the money closer to 80%? So Robert, as you saw in those trades, I typically go above 80%. James asks, what is the minimum credit we should receive for an Iron Condor? Is it approximately 20% the width of the strikes? Anywhere from 20 to 40%. Sometimes I will go a little more aggressive, but for the most part, it's anywhere from that 20 to 40% range. Cecil says, if it hits short strike before expiration, will you roll it up or down? So Cecil, I think I talked about that before. I typically will get out of the trade if it's stop loss. If the adjustment's if the move is early in the expiration, I'll adjust. If not, I'm just going to go ahead and get out of the trade, take a small loss, and then move on. I'm okay with that because, again, I want to allow those probabilities to work themselves out. Um, let's see.
I see a question here from Maxwell. He asks, how much do you need to start? And I know we're not going to tell people, you need X dollar, a specific amount, but to do one contract, one Iron Condor trade, how much capital do you need for one? Let's say if you're doing one trade, one contract.
I mean, if you're doing one, it depends on the width of the strikes, but you can easily do these trades for anywhere from $300 to $500. That being said, it probably doesn't make sense, but just from a commission standpoint, and then obviously there's other factors as well. But you can start trading these Iron Condors, learning the system, learning how to do them for as little as $500.
I
If
mean,
not
Andy,
less.
let's say that you were trading, let's say that Maxwell wanted to trade three contracts. Let's just say it's, 300 a contract or something. It's so like $1,000, you could do one of these trades with three contracts. And in an average month, in Andy's options advantage, he's doing what, three trades a month. So again, for, $2,000, $3,000 in capital, you could be trading three contracts twice a month with this type of strategy.
Well, well, actually, so again, it goes back to how many strikes wide you are. So if you're doing like what we've been doing in the past and what we'll continue to do, which is 2 strikes wide, and then we bring in 50 cents, that's going to cost you. That's going to be a maintenance requirement of 150. So you could do 2 contracts for $300. You could do 3 contracts for $450. Now, if we were to go 3 strikes wide and we bring in 75 cents, that means that you could do 2 contracts for $450. So so it basically depends on the width of the strikes. But for $1,000, you should be able to do anywhere from 4 to 5 strikes, if not more, or 4 to 5 contracts, if not more, fairly easily. And again, that depends on the width of the strikes that you're using. That being said, obviously, the more capital that you have to trade, the more the higher the probability that you will be successful over the long term. Peter says, do you have a link to how set up your watch list columns with RSI 2.5? So basically, Peter, we do have a video on our watch list. I don't think I necessarily mentioned this in the presentation, but I provide a watch list of all the highly liquid ETFs that I trade for Options Advantage subscribers, and I do this on a weekly basis. And it basically not only tells you which ETFs are highly liquid, it also informs you as to whether or not something is overbought or oversold, which just means if something has moved, a couple standard deviations above its mean, it's overbought. If it's moved lower a couple standard deviations below the mean, then it's in an oversold state. And these are oftentimes really good times to enter into a particular trade. Let's see. KQ, yes, this is being recorded. Let me go to some of the more recent trades, or recent questions.
Do you want to go to the trading platform and do some trades?
Yeah, let's do that.
Because I know we had some people here. I'm just pulling this up right now. I see Robert's asking us to trade WBA and TRIP. Carl is asking for NVIDIA. Klaus is asking for Iron Condors on IBM and Goldman Sachs. Anybody else have some stocks or ETFs you want us to trade? We'll do a few of them. Why not? So yeah, let's do it. And again, I want to encourage everybody. Our website is www.tryoptionsadvantage.com. I want you to go there right now, claim your spot right now. We can do it right now. We can get you into the best available price. You're going to lock this in. You're going to be locked into this price forever, whatever you select right now. So if you select $9.95 for 1 year, you'll be locked in there. You'll pay that a year, every year. You're never going to pay a higher price. It's going to be that best price. You're going to be locked in. So again, go and do it now, www.tryoptionsadvantage.com. That's going to take you to my secure website. You can sign up and claim this amazing deal right now. So Andy, let's go ahead and do some trades. I know we have the trading platform up right now, so let's do it.
Yeah, so someone had mentioned Goldman Sachs. So let's talk about Goldman. So basically, we don't really necessarily care where what's going on with Goldman. We just need to know that Goldman's a highly liquid stock, first of all, which it is. Next thing that we need to look at is if the bid-ask spread is fairly reasonable. And as you can see, here's the bid, here's the ask, and if you look at the money strike, which is right around the 220, the 225, it looks as though the bid-ask spread based on the price of Goldman Sachs is fairly reasonable. So if we were to do Goldman Sachs, or I should say I will do Goldman Sachs, that even though I prefer in the Iron Condor's portfolio to stick with ETFs because, again, they are inherently diversified amongst a variety of stocks, and we don't want that exposure to headline risk. Goldman I would look at, say, the 80 percentile. So we'd look at let's say, the 240s, and we would look at, on the put side, we'd look at probably the 200s. So if we were to, so basically, what you're doing is the first thing you want to do when you're choosing an Iron Condor, because again, it's a range-bound trade. You're creating a large range that an underlying can trade in, and that it typically trades in, and you're taking advantage of that. And as long as it stays within that range, that large range that you've created, that has, in most cases, at least the way that we use it, over an 80% probability of success, or an 80% chance that it's going to fall within that range at expiration. And that's what you want to do. Is you want to set up those short strikes first. Once you have chosen those short strikes by looking at the associated probabilities, you're then going to define your risk by buying the strikes that are even further out of the money. So in this case, if we are selling an Iron Condor, and again, we're going to sell the 240s, so we're going to buy the 245s. If we sell the 200s, we're going to buy the 215s. And we're able to bring in basically, if you look at the mid price, it's 255, so we could probably bring in 250 to 255. That's 50% of the cost or the maintenance requirement. So our return would be rough on this particular trade, would be almost 100% on this particular trade. Obviously, we're not going to shoot for that. Now, if we want to widen this out a bit, and let's say take instead of the 220s, which is just below, we want to go out to 200 because that's where that 80% probability is. And then buy the 195s. So that's going to give us a 40-point range. So as long as Goldman stays within that 40-point range between 200 and 240, we're going to make a max profit of basically around 120. Now the return on that trade is just going to be 120 divided by 380. Now how do we get that 380? We take the 5 strike wide minus the amount of credit that we were able to bring in, which in this case is going to be roughly 120 to 125, and that's going to give us a return of 31.6%. Now we're not going to take that 31. We're not in most cases going to allow that allow Goldman shares or stock to carry through expiration, which in this case is 58 days. We're going to simply get out of that trade at about 30 to 45 days, if not less, and get out of that when we're able to reap at least half of the premium. So when that price goes from 120 down to, let's say, 60 or 55 cents or 50 cents, we're going to go ahead and get out of that trade and then create another opportunity for more income by placing another trade. IBM was another that was mentioned. Same thing, August expiration, IBM's trading for 154. Again, is it highly liquid? Yes, it is. Are the bid-ask spreads tight? They are. So we're going to go through the same process. Now, as you can see, some of these stocks, and this is another advantage of ETFs where you're able to go out 3 strikes wide. You don't have that ability here. You have 5 strikes wide. That's the minimum you can go out. You can go out 10 strikes wide if you wish, but 5 strikes wide seems to be more reasonable. And that's usually the case for stocks, which is another reason why we choose to use ETFs within the Iron Condor portfolio. And again, we've shown success in that portfolio. We're not going to stray from success. Again, it's not about hunches or guesses. It's about allowing the probabilities to work themselves out and sticking with a plan, a strict, disciplined plan to allow those probabilities to work themselves out. So August, we will go with the we have a choice between the 160 and 165. The problem is if we go with the 165, even though the probability is 88%, we're not going to be able to bring in that much premium on a 5-strike white condor. So we're going to have to lower our expectations down to 75%. So in this case, we would sell an iron condor with at the 160, buying the 165. Now on the put side, we're going to, again, we can go to the 74, which is the 145, or the 140. So to keep, so because, and this, I always side with a bigger range on the downside, or a bigger spread on the downside, because markets typically crash lower, they do not crash higher. So knowing this, I usually give myself a little more room on the downside. So typically my probabilities will be slightly higher on the downside than they are on the call side. So if we were to follow suit with that thinking, we're going to choose the 140 because it has a probability of success of 84.8%. So we will go with the, we will sell the 140, and then we're going to buy the 135. And by doing so, we are able to bring in roughly 130 on this particular spread. Now, we would bring in 130 in credit. That's going to give us an overall return of 130 divided by 370, and that'll give us a return of 35.1% if IBM closes at expiration within the 160 to 140 strikes, within that range. Now, again, as I said before, we are not going to typically wait until this carries through expiration. We're going to get out of it early, and again, the reason why we get out of this early, because all research shows that it's more beneficial to get out of your trade when there's 50 to 75% of the premium that's already been eroded or sucked out of that original premium than it is to hold on to expiration. And that's why we've been able to bring in 9% per trade on average, and only been exposed to the market 24 days. And that 24 days, that includes weekends as well. So it's actually less than that when you include just the actual trading days. It's more like 17 days or 20 days. So those are 2 additional trades. Let's see. Looks like there's more questions. So Kobe asks, what is your average days to expiration? So typically, as I said, it's anywhere from 25 to 56 days, or 25 to 65 days. My sweet spot is 56 days, getting out of that trade when there's basically 30 days left until expiration. Billy asks, what's your criteria for taking them off? My criteria for taking them off is either they have reached my stop loss, which is double the amount of the original premium that I brought in. So if I brought in 50 cents, I'd get out at $1. Now, or if I'm able to take that trade off when 50% to 75% of the overall premium has been eroded. So if I had, let's say, $1, I would get out of that. If I sold an iron condor for $1, I'd get out of that when it reaches 50 cents to 25 cents. That way I can lock in a 50 to 75 cent profit on that particular trade. KQ, do you ever have trouble getting out of your trades? I don't, because I only use highly liquid trades. Now some of these trades that Ian had mentioned before, I'm not even going to go into, and the reason why I'm not is because they don't have the liquidity. The bid-ask spread is too large. What does that mean? That means that you're not going to be able to get efficient prices. You're not going to be able to get in or out of a trade in a timely manner if a trade moves against you, because the volume is just not there. If the key to using highly liquid underlying ETFs and stocks for that matter is the efficiency in trading. Again, it's all about the math. Every single thing that we do within the Options Advantage service is based on a quantitative approach. It's based on statistics. We don't want to have to make 15, 20 cents, I should say, we don't want to make 15% to 20% just in a trade, an iron condor trade, just to get back to break even. And that's what often happens when you're using a stock or an ETF that is not liquid. Let's see. So it seems like a lot of the questions, I covered a lot of the questions regarding stop losses, taking off profits. So Klaus, I hope that helped. Same with you, Jim, Natalia as well. Um, Stefano asks, is it better to trade index to avoid early exercise possibility, reduce commission costs, for example, SPX instead of SPY? If you're trading a larger account, SPX can often be helpful rather than using SPY. As for early exercise, because we are going because we're using high probability strategies, and that have out of the money strikes that are, depending on the underlying, anywhere from 10 strikes out to 15 strikes out, 7 strikes out. They're all out of the money. The chance of being exercised early is slim to none. You're going to be exercised if something moves in the money. That's typically the only, and it has to move far in the money because there's a time premium associated with that. Now, even if something moves in the money, because this is often a question that I often get, all you have to do is go back in and reverse that order. So just basically close out that order. It's very easy. There's no penalty for being exercised. The fear, people have this unnecessary fear when it comes to being assigned or exercised, and that's just because it's just a lack of understanding, and rightfully so, because if you didn't realize how easy it was to get out of the trade, or that it's okay, then it could be a scary endeavor. But I can tell you that for one, it rarely happens, and when it does happen, all you have to do is, like I said before, just go back into your trading account and get out of the trade. It's that simple. And oftentimes it can lead to depending on the price movement, it can actually help out your trade. Kobe says, do you mainly only select ETFs on indexes and not on individual stocks? Kobe, yes. As I said before, I'd stick with ETFs because, for one, they're inherently diversified. And as I said before, I stick with ETFs that are highly liquid, SPY, the Qs, the diamonds, IWM. I've been trading IWR as well. And I have a long list of about 30 to 40 ETFs that, again, I publish on a weekly basis to Options Advantage subscribers that goes over not only the highly liquid ETFs, but where they stand on an overbought to oversold basis. You're welcome, Andy.
And Andy, when is your next members only webinar? When is that happening?
So the next members only webinar will be in 2 weeks. So that should give everyone ample time to go through the reports, watch a few videos, email me any questions that they have, or if they wish, give me a phone call. And then the way that these subscriber-only webinars happen is that it's basically, I take all, it's one large, so basically the beginning of the presentation, the subscriber-only webinars, I go over a facet of options trading, and it's typically very educational. I then follow that up with a Q&A session, so I take all questions from subscribers regarding any open trades that we have, any past trades, any strategy-related questions, basically anything options. I also go over all of the open trades that we currently have also, because that gives people an idea. Not only that, but when I open a trade, I include all that information, but then I follow it on a week-to-week basis in the weekly update that's provided to subscribers on a weekly basis. This allows us to keep things in check, and it allows us to go through that thought process of where we are on each individual trade that we have open, what our thoughts are, whether we need to close it, where the credit stands, where that trade stands, are we going to take a profit early the following week. It's a great way to learn how to trade these strategies, because you're following it on a week-to-week basis. We're not just going to send out an alert and then let you fend for yourselves. We send out the alert, we follow that trade through its life cycle, and we include the original trade alert in the weekly update along with our updated comments on that trade. And then not only that, but we send out an exit alert as well, that tells you as to why we exited the trade, so on and so forth, whether we're taking a profit or a loss. So hopefully that helps. Um, let's see. Seems like a lot of these questions. Ian, do you have any other do you see any other questions or?
I don't. It looks like we've had a great event. I know people are pretty excited about this. We've enrolled tons of people already. So welcome to all of our new Options Advantage members. You'll be, stay on the lookout for that email with the invitation to the members only webinar. Let's go ahead and put up our website again, though. Let's put that up right now. I like to think that, people at this point, you're at a crossroads. You have a decision to make. Either you can keep doing what you've been doing, and you'll probably get similar results, or you can take the next step and you can get started. We talked about how the biggest concern that a lot of folks have related to iron condors is they think they're confusing. Well, I think Andy has done a great job with all of the examples today, showing you that. Well, it may seem a little bit confusing. When you have the reports and you have the alerts and you have the videos, he's going to walk you through exactly how this works and make it as simple as can be. The number two concern that people had about iron condors was the cost of trading commissions. And we talked a little bit about that too, about how to save money with commissions. We talked about a number of different brokerage firms that offer lower commission rates, so I think that hopefully helps as well. Andy, when we ask people, what's their number one trading challenge, and I'm going to put this up, 30% of people said inconsistent trading results were their number one challenge. The second was managing risk. When we talk about people wanting to, have consistent results and managing risk, nothing is better than an iron condor trade because the risk is defined. We really believe that this is one of the best ways to trade in this market. And when you talk about consistency, when you're winning 90% of your trades or 80% of your trades, I don't know about you, Andy, but I consider that to be pretty consistent. And I think that's exactly what so many folks are looking for in this market. Is they're looking for ways to earn income in any environment. And they're looking to do it consistently. They don't want to, have 1 out of 2 trades be a loser. They want to have that consistency, consistent income, consistent returns. So I think this strategy is perfect for all of that. And I know that Options Advantage provides people with what they need in order to get started with this. And so our website is www.tryoptionsadvantage.com, or our phone number is 888-875-1960. We'd love to chat on the phone or to enroll you online. Now's the best time to get started.
Yeah, and this is, you had a question regarding the confusion. Iron condors are one of the more simpler strategies when it comes to options. It's just a matter, just like anything else, to educate yourself and then start paper trading, start small, practice, get familiar with the strategies, and then employ some capital and start trading. You want to employ that capital and start trading when you have a plan in place. And again, that's where that 30-day free trial kind of comes into play, because it allows you to educate yourself, not only through the reports and the videos, but also to contact me directly, and then we can go through any type of reservations that you have regarding the strategy or how to use the strategy, because we want to steepen that learning curve, because this is a very valuable strategy, and that's why it's one of the most popular strategies among options professionals, and it's a great way to bring in income on a consistent basis. Again, we've had a lot of success in this portfolio this year, and I expect to see continued success, especially if we start to see implied volatility as seen through the VIX move higher. Now that's something that I haven't even talked about today, but we've received 9% on a per trade basis in one of the lowest implied volatility environments in history. We are at historically low levels in implied volatility, yet we're still able to lock in 9% on average per trade using these condors. Now, once we start to see a little bit of fear move back into the market, that 9% will most likely increase anywhere from 13, 14, or 15%, because we're going to be able to sell more premium because there's fear is going to move back into the market. So hopefully that helps. Again, it's all about starting up, practicing educating yourself, using me as a resource to help you steepen that learning curve.
Great. So Andy, thanks for doing the webinar. This has been great. It looks like questions are pretty much wrapped up at this point. I think we've addressed everything. Yeah, I think we should let's wrap it up unless you have any final thoughts, Andy.
No, I think that's it. I think it's been a wonderful event, and I hope to see all of you on board very soon.
Great, sounds good. Thanks everyone, and remember www.tryoptionsadvantage.com. That's our website, or pick up the phone and give us a call, 888-875-1960. We look forward to welcoming you. We have that premium package available right now with all the extra bonuses. Let's go ahead and just put that up there one more time, Andy. Show people all those bonuses. And so, do you have that image there, Andy, with all the bonuses in the books, everything? Yeah, so that's what we want to send you right now. I can get it out in the mail to you this week. Go ahead, go online, www.tryoptionsadvantage.com, or pick up the phone, 888-875-1960. Let's go ahead and put that number up one more time, Andy. It's just on the next slide there. If you just go forward one slide. Great, there's our phone number. There's our website. We'll look forward to welcoming you to Options Advantage. Thanks so much for your time today, everyone. We've really enjoyed it, enjoyed the webinar. Thank you to all of our new clients. Thank you to our existing clients who are here today. We appreciate your business. So Andy, thanks for doing this event. It's been great.
Yeah, thanks, Ian, and thanks everyone for attending. And as I said before, I look forward to speaking with all of you. Take care, everyone.